Happy Sunday, everyone. In today's video, I'd like to share the results of a data exercise that we did over the weekend. The purpose of the exercise was quite simple. I was trying to see what did volatility look like last week, and can we actually prove using data that we saw increasing volatility into the week? And not only did we see that, but we were able to profit off of that increased volatility, at least with day trading activity. So now, over the course of this video, this is a chart that we'll be referencing quite often, and in fact, we'll be focusing on the line chart here, but let me talk about what this represents. So the green line represents the total number of trades that we had, and this is trades that we had hit our live scanner, which is something we've built into our stock volatility box platform. It's quite powerful. Really, every 15 to 20 seconds, it's updating with new trades where we have price breaching our volatility box edges. Now, off of that, I've just added in two very simple filters. One is time, which is I'm only looking at entering new trades between 6 to 10 a.m. Pacific. And then the second is it needs to have been on the live scanner for at least 3+ minutes. The reason for this is, again, just to assume that 3+ minutes gives you more than enough time to actually enter the trade. It wasn't one of those where we breached our volatility box clouds and then very quickly hit our target, right? So these are trades that you actually had an opportunity to enter. Now, using both of those filters, let's take a look to see what the results were like. So we already said that the green line represents the total number of these trades, and we'll talk about each of these days in further detail, but now the blue bar represents the P&L for those days. So what should stand out right off the bat is really from Monday onwards, we saw an increasing number of trades, or at least breaches of our volatility box between 6 to 10 a.m. Pacific. Right, so on Monday we were closer to the 40s, and by Friday we were much, much higher, right? Almost 4x in terms of the amount of volatility that we saw from Monday through Friday, at least with our stock volatility box tool. So that results in opportunity. Now, starting Wednesday, you should notice that our blue bars really spike up higher, and we start to see a decent P&L, especially with the increasing number of trades that hit our volatility box, with really Wednesday being that perfect gem in terms of a balance in which we had a really high winning percentage rate, which also translated in terms of the actual P&L that we were able to experience on that day. So we'll go into all of this in further detail, but the first few things that stand out again are increasing number of trades Monday through Friday. Never do we see a dip below. So Monday was lowest in terms of volatility. Friday was highest in terms of volatility, also supporting that fact that funny things tend to happen on Friday, and this Friday was nothing short of different of that, regardless of whatever the news catalyst may have been. Now, the second factor is the P&L. Now, while Friday was the highest P&L, to me, Wednesday and Thursday stand out particularly because you were able to capitalize on having a much more manageable number of trades that hit our live scanner between 6 to 10, most of which were winners. So now let's go into each of these days into further detail. So let's start off with Monday here. Now, using Monday, we know that we had 40 trades that hit our volatility box using those two filters. Now, we have 4 different models or trade ideas that we can take a look at. One is an aggressive long, and this is using our aggressive volatility box, an opportunity to get long. The same way we have an aggressive short. And then conversely, we have our conservative models here, which is conservative long and conservative short. Now in this exercise, we don't take into account the edge signal, we don't take into account earnings and using conservative models. So this is really to paint you sort of the worst possible picture. What does the worst picture look like? And once we start to add in our rules, that only gets better. So now with our aggressive long, we had a winning percentage of 57% and a net P&L average per share of that model of 88 cents. Now on the short, we had 50% with 66 cents per share. Off of our aggressive long, we had 100%, but this was only one trade, and that was a 5-cent winner, so fairly small. And then off of our conservative short, this was the model that did not work on Monday. That was only 38% with a net loss of negative 70 cents per share, and our total was 89 cents per share. So whenever we see this number being above 0, that lets us know that we ended the day positive, at least using the models. And that's really how to read this. Above 0 is good, below 0 is bad, means you ended the day negative. So now here, out of our 4 models, only one model didn't work, and that was really trying to short the market on Monday. That really just didn't pan out. You had a 38% winning rate with a negative 70, but everything else for that day looked fairly nice, right? But what should stand out here is a fairly muted day, 89 cents, nothing really to write home about off of the entire day's activity, and you'll see how this progresses as we go further down into the rest of the week. Now, switching over to Tuesday here, Tuesday we had more trades, right? We had 40 on Monday, now we have 56, and off of the 56, we had a 60% win rate on our aggressive long for a net P&L of 2.78 per share, which is again above 0, a nice number that we like to see. Aggressive short was 40%, so we saw a little bit less here. We also gave back a chunk of that in terms of the models just weren't profitable here, so negative 85 cents per share. Conservative long, a nice winner, 75 cents. 49 cents per share here. And then our conservative short, again, didn't work out. So what should stand out here is both shorts really didn't work out on Tuesday, and Tuesday was just not a good day to short. Despite that, however, even with our long opportunities, we ended the day positive, and that too more positive than Monday for a positive $1.29 per share per trade taken. That's sort of the expectancy that you would look at. Now, if we move on to Wednesday here, you'll notice, again, an increasing number of trades, right? This time we had 74 trades that met those two rule sets, and Wednesday was really the best day that we had last week. Off the aggressive long models, you had a net winning rate of 62% with a positive 4.33. Should already stand out how much greater these numbers are. But really, the P&L isn't what I would focus on here. It would be the winning percentage rate, because the P&L is different, again, with the share size, right? A share like Shopify is much more expensive than a share like, say, Marvel. And so that's where I think P&L I've included for those of you that like to see it in a dollar amount. But the winning percentage rate, I think, tells a better story here, which is our aggressive long, 62%, 4.33. Our aggressive short, 48%, but still a positive 6.38. Our conservative long, 83%, positive 88 cents. And our conservative short, 73%, positive 1.69. And our net P&L for the day, if we take the sum for all four models, positive 13.28. And this is if you took every single trade that hit the live scanner, again, within 6 to 10 a.m. Pacific and was on the live scanner for more than 3 minutes. So this is about as simple of a trade as you can make it, right? We give you the entry, the stop, and the target that all of these prices are actually using. Now, once we start to layer on our rules, we see that we increase not only the P&L perspective, but also the selection in terms of the trades that we're willing to take. And it helps us to filter down from the 74 number down to something that's a lot more manageable. Now, once we get to Thursday, we'll notice again that number continues to increase, right, from 40 to 56 to 74 to now 82 trades, but that winning percentage here went down a little bit, especially with our short entries here. So let's go through this. Aggressive long was 77%, and that was really the nice winner that made the day still end positive, positive 9.99 per share. Then our aggressive short was 44%, but a negative $0.08 per share traded. Our conservative long here was 55%, again coming back to positive, positive 1.36. And then our conservative short here matched our aggressive short in terms of a winning percentage, 44%, but a little bit less in terms of P&L, only negative 53 cents, still to help us end the day positive. All to say that buying the longs on Thursday was the thing that really helped us to continue to profit. And I think longs are really the trade that most people are a little bit more comfortable with as opposed to shorting shares. Now, for most of these trades, you have an opportunity to use the underlying, which gives you a commission-free trade, or you could switch it up, use options, which is something that I found to be incredibly valuable on Friday. And this is something that another user actually found, but it's when you use 0 days expiration options on Friday, you start to do things like selling spreads. This really skews the risk reward in your favor, right? This is where you can start to do something like risk 1 to try and make 3. To give you an example, an IWM spread on Friday, this was off of the futures volatility box, but that was where it was a dollar wide spread sold for 62 cents that you could buy back for 10 cents into the close. And that's where it was almost a stress-free trade. You've risked really 32 bucks per contract. You can scale in based off of whatever your risk size is, but that really starts to skew the risk to reward, right? Especially once you have these models in which you have high confidence that, hey, if it's happening between 6 to 10 a.m. Pacific, I, for the most part, expect X, Y, and Z to happen. So if I already expect X, Y, and Z to happen, and now I can also start to skew the risk to reward in my favor using options, that starts to become really interesting. Now on Friday, to conclude, we had a huge jump up higher, right? So just to give you an idea, we went from 40 trades on Monday to 157 trades on Friday. And this is still meeting the same two rule sets, stopping trading after 10 a.m. Pacific so that 9 to 10 a.m. is the last hour that you're willing to trade. There we had 157 trades. Out of the 157, despite having so many different entries, this should give you an idea of how effective these models are. We fluctuated still within that 50% zone, right? Our aggressive long, 45% winning rate, but still a positive 13.75, which should give you this notion that our winners were much bigger than our losers. Our aggressive short here, 55%, positive 84 cents per share. Our conservative long, 52%, positive 2.17 per share. And our conservative short, 63%, with an 89 cents per share. So again, all four models being profitable for a net P&L if you added all of these up to be 17.65. And so that starts to become really interesting. You're telling me you had 157 different trade opportunities, and if you happen to take all 157 trade opportunities, you still ended the day positive, where your P&L was positive, your probability per trade was above 50% on 3 out of 4 models, with the one where it wasn't still being 45%, and also being the biggest winner on the day. And so this should again give you an idea of how effective these models are. And so doing this analysis this weekend, if I'll tell you what my takeaways are from this, and you can gather your own takeaways, and again, start to dive deeper into whatever trade parameters you may be willing to add on top of those basic two filters. But it's the idea that we're seeing volatility increase as we get further and further into the week. Fridays are generally funkier than I think other days in the week. Mondays are generally much, much slower, less volatility. Also, just it's a day to ease into the markets. And really, when we see this increased volatility, if we start to add in just some simple parameters, some simple filters, keep the trade fairly simple for the most part, right? It's our trade setup is we're looking for a volatility box breach, which means it's hit our live scanner. And once that happens, we want to see an edge signal, which is an overbought, oversold confirmation. If you don't like the edge signal, you can use the RSI, whatever really floats your boat there. But the models are the secret sauce here. The models are where we're really looking at this trade as a potential entry, then using a rule set and overbought, oversold indicator to confirm an entry, and then looking to see whether or not these probabilities are met. And in fact, we're looking to beat them by at least starting to add in some of these rules. That's where I think this starts to become a really easy system where the system does most of the work for you. The live scanner gives you a list of trades updating throughout the day wherever we have breaches. You can pick and choose from them based on whenever your schedule allows for it and start to trade the rule set and really start to profit off of any volatility that we see in the marketplace. All right, I hope this video helps for those of you that are looking to at least prepare for this upcoming week in terms of the kind of volatility we may see. Good luck trading, and we'll see you in the next update. Take care, everyone.